Hello, welcome to our module on credit spreads. What we're going to do in this section is we're going to actually talk about credit spreads, how to take money in on a spread, different types of credit spreads. We're going to talk about entry rules, exit rules, and also we're going to do a wrap-up on all vertical spreads. So what we're going to function on basically here is two strategies. We've got an income strategy for you, and we've also got a wealth builder strategy on credit spreads. We're going to talk about bull put spreads. We're going to talk about bear call spreads. Okay? The two types of spreads we're going to cover here. First is the bull put spread. This is a bullish trade, a bullish strategy. It is an income strategy. We also have a longer-term wealth building strategy we want to show you. Also, we want to talk about the bear call spread. This is a bearish trade. It's an income strategy. It's one that George and I like to do around earnings reports. Kind of that buy the rumor and sell the news thing that happens so much in the markets these days.
Okay. Yeah, exactly. What we're going to do here is it's got two very interesting strategies, and what we're going to try to do is show you how to be a little creative too, not just your standard, run-of-the-mill, get it from the book type strategies.
That's right. We've got a couple of really neat ideas of this this type of strategy, and as well as how to put these on, how to take them off. Let's first start talking about a risk graph that you and I know well, and that is the naked put. This is a bullish trade. This thing really started catching on in the 90s.
Sure, exactly. A lot of people thought it was the way to financial freedom, and it actually was the way to financial bankruptcy.
That's right.
It
very may well have worked for most of the 90s, but
Sure.
but with the turn of the stock market just getting really blown out of proportion, premiums got real expensive, and people just thought, they just can't get any better than this. And this particular type of strategy looked good again, probably most of the time, but the last couple of years getting into the year 2000. Definitely the wrong way.
Well, remember, selling the naked put means that the stock can go to zero. So there were a lot of people selling these puts on stocks that were, $100, $200 in some cases, and sometimes even $10. But stocks go down, and you got to remember it's just got a very ugly-looking risk curve, which is something you guys need to look at. So, that old term of read my lips, never sell naked puts, this is very important in this
That's right. And again, looking at the risk graph, guys, you'll notice that, and we have something up there that says wrong way. Basically, what you're doing is you're taking a little bit of money. How'd you like to take a little bit of money and risk everything you own? That's basically what a naked put looks like. And the risk is, we say it's unlimited, but it really is limited to zero. The problem people get into with naked puts is that first they find out that most brokers only require 20% down to do this. So, you could actually leverage up to 5 times your account on one naked put. The problem is that after you lose 20% in the stock price, that's when they start calling you. You'll get margin calls, and if you can't meet those margin requirements, then they're going to carry the stock away or carry the position away from you, exiting it out, and then you're left with it, whatever you can get out of that trade.
Well, what we want to do is just show you a much safer way to do something similar, but you're going to be able to sleep at night, and it actually produces income too.
Yeah, we call this the right way, and that's how to sell naked puts without being naked, and that's with something called a bull put spread. This is one of a couple examples we have in different modules, but I think this is really the very first one that you can take a look at as an alternative to selling naked puts and still being bullish in the marketplace. So what we're looking at doing, guys, is we're looking at selling an at the money or in the money put, which is the higher strike put, and we're going to buy the out of the money, the lower strike put. So it's the same as a bull call where we're buying the lower, selling the higher. It's just that now we're using puts instead of calls. And if you take a look at the risk graph, now doesn't this look better?
Looks a little
This
better.
is much better. This is all of a sudden now we've taken that falling off a rock risk curve that we had, and we're actually kind of putting some protection in there. And this is what we call the right way. It has limited risk. Now it has limited risk, limited reward.
But it's still better. I mean, honestly, it's still better than selling naked puts. I mean, one thing we've always, as we teach this and we go around the country, we realize that people make a lot of big mistakes, and the biggest one's the naked puts. So the bull put spread, we told them, was a much better way to do it. What you're going to do here, remember, this is a credit spread, so you're going to sell a higher strike put, which means you get more money than the one that you buy.
Right. And as a credit spread trader, your objective in this case is you want to keep the money, the credit you bring in. You want to try to pay as little of that back as possible. It's merely selling something at a higher price and buying it back at a cheaper price is how you take your profit in on a credit spread. Exactly. Now, bull put spreads. We're going to talk about bull puts. First of all, you got to be bullish on the stock. Really not necessarily, but you want the stock to remain where it is or move up over time. Mm-hmm. And we've got a couple of different ways of doing this. We can, number one, take a shorter-term approach. This is what we call the income strategy. Basically what that means is we're looking at options that have less than 90 days to expiration. Mm-hmm. We're looking at higher, like an uptrend, higher highs, higher lows, anything that you are forecasting the market to move higher at over the duration of the spread. And, of course, a credit spread would not be a credit spread unless you do it at a credit, okay? If you put the trade on and it comes back as a debit, you may have wound up doing a bear put spread instead of a bull put and maybe did the wrong thing. So you're going to, once again, buy the lower strike, sell the higher strike.
And remember, a credit spread means that you have sold an option that is more expensive than the one that you bought. That means you've taken a credit into your account.
Okay, let's take a look at a bull put spread example. George, why don't you show us what we're doing here with this example?
Yeah, let's say IBM. We've been using IBM a lot here, huh? IBM is at 100, okay? So what I like to do is try to graph everything out. So let's put 100. Remember, the 100 would be what kind of options? At the money options. So then you're going to have basically options above, options below. So let's just add some strikes, 110, 120, etc. Okay, somewhere in the middle here, why don't we go ahead and let's do a 110, 115 bull put spread. Sorry there. Let's start that 115. What you're expecting to happen here is IBM, let me just kind of give you a graph. IBM starts to move up. Remember, if you sell the 115 put and you buy the 110 put, this will be a credit trade, unless you got a really bad fill. Okay, that's a joke. It should be a credit trade because you're selling the higher strike put. And what you want to happen is IBM to close above 115. What happens at that point is this would expire worthless, and this would expire worthless. That means you get to keep the credit. Let's assume basically here we took a $2.50 credit, okay? What you need to do is figure out risk and reward just like we've always done. Let me go to a new page on that. New page. Let's create our handy-dandy risk graph, okay? I'm going to be an expert at this by the end of these videos. Okay, there's 0, your break-even line. The stock goes up, stock goes down, okay? And this is what you make or you lose. In that example there, we had a credit equals 2.5 or $2.50. The way you calculate your risk, okay, once again, there's two things we always calculate, risk and reward, and then reward. The reward on a credit spread is your credit. The most you can make is your credit, okay? The risk will be the difference in your strike prices, SP, minus your credit. In this case, it's also $2.50. So if we were to draw our bull put spread, basically it looks like a bull call spread. It looks exactly like a bull call spread. It'll go like this, straight up through a break-even point, also across. Once again, you can lose 2.5, you can make $2.5, okay? And that's pretty much what it looks like. Just similar to a bull call spread, it shapes itself over time, okay? Basically, over time, it starts to create itself. And what you want, remember, is just like in the bull call spread, each of these, let me put a little different color, each of these points is where there's been a change in price, or the different strike prices we were doing here, okay? So what strike would this be? The 110, 115 up here. The good old break-even point. How do you calculate your break-even point? Okay? Well, once again, remember where the risk is on this trade. The risk on the trade is basically if the stock, you can kind of see here, closes below that break-even point. So what you're going to need to do is, remember, the risk is at 115 on downwards. So what you're going to take is you're going to take your higher strike minus your credit will equal your break-even point. Here you got 115 minus 2.5. We've got the famous 112.5 break-even point. Did I do that right, Tom?
You did. And there's another way you can calculate risk too. And this is the way I do it. And I think either way is going to be, you're going to get the same answer. But what you could do also is looking at the graph that George drew out. You could take the $2.50 risk that you had and just apply it to the lower strike. So just like a bull call spread, you take risk plus the lower strike. You do the same thing here. You could do risk, which is 2.5, plus the 110 put. It's still going to give you that 112.5 break even. So either way is going to work.
Right. Yeah, the problem we have, at least we've seen, is a lot of people never even get to this point. They don't even know what they're doing when they're putting on a bull put spread. They read some book somewhere along the line said, selling naked puts is good, and then they didn't even know what they were getting themselves into.
Yeah, and guys, with bull put spreads, just think of it this way. If you really are that intent on selling a naked put, all that you're doing here is just adding on a level of protection by buying an out-of-the-money put just in case. Who knows what could happen?
Sure, exactly. It's a much safer thing. You have to put up less money.
So let's look at the, let's kind of summarize on the risk graphs, maximum risk break even. First of all, on a bull put spread, the maximum risk, once again, is your difference in strike minus your credit. Okay, that's what you do. You get to determine maximum risk. Maximum reward is just the credit you receive. Whatever you bring in, that's the maximum allowable credit you're going to wind up taking. And that would be if the trade were to expire worthless. So if you bring in 6 points and the trade goes to 0, you keep all 6 points. You don't even have to get out of the trade.
Right, exactly.
That's one thing that's kind of neat about these things, is if you're really right, you can just let the trade expire worthless, and you don't have to pay the extra commissions to get out.
That's why a lot of people like them versus bull call spreads.
Yeah. The break even is the last thing we want to cover, and George talked about it already, but to reiterate once again, generally speaking, the break even, you're going to take the higher strike price, as he had mentioned, and you're going to subtract the net credit from that to get your break even. So those are the 3 points that we want to cover with you as far as looking at the risk graphs and visualizing risk and reward. So let's go ahead and take a look at another example here. IBM, let's say IBM's trading at $100 a share. Okay. IBM's been trading at $100 a share since we got started. So
we should be using some other strategies.
That's right, the sideways market trades. Actually, what we're going to do is we're going to look at IBM trading at 100. We're going to look at buying the lower strike, selling the higher strike once again. We're going to sell the 100 put, and let's just say that gives us a premium of 5 points. Then we're going to buy the lower strike put for protection. That would be the IBM 95. We're going to pay $1 for that. Now, first you got a maximum reward. Okay, your max reward is going to be basically the 5 minus 1, the strike you're buying from the strike you're selling with minus the difference between strikes. So that gives you 5 minus 1 is 4. Yep. That's my maximum reward. Maximum risk is going to be difference in strikes times 100 for $100 per point minus your credit. So your risk is going to be what? You got a credit of 4. There's 5 possible points in there, so your risk is going to be the 5 minus 4, which is $1 or $100 in dollar terminology. The break even is going to be the higher strike price, which is once again the 5 minus the net credit, which gives you also a break even would be $100, which is the particular price that this was trading at, minus the 4 credit. Gives me a break even of 96.
Sure. Let me show them a little something here. This is these are 2 very different bull put spreads. In fact, let's go back to our IBM at 100. The first one we did, remember, is we sold the 115 put and we bought the 110 put. Okay. Now this one here we sold. Let's put another example. We sold the 100 put and we bought the 95 put. Okay. These are, just like in the bull call spreads where we did in the tape, these are different types of trades.
I
mean, yeah, exactly. This, remember, when you're looking at puts, when a put is above, this where the stock is trading, these are called in the money. Okay, so this is in the money bull put. Okay, when you're trading right around where the stock is trading, this is an at the money bull put. Well, you know what? You could do one down here too, can't you? Sell the 80 put, buy the 70 put. This would be an out of the money bull put. They all have the same way to calculate the reward and risk ratios, but really they have different risk profiles.
They do.
Very much so.
Our students ask about these all the time.
Yep.
Where should we place these things?
Yep.
And it really depends, because you've basically got here 2 of these represent to me an income strategy, which means that if I were to draw a dotted line across here, The ones below the dotted line
Right.
are the shorter term
Exactly
trades.
right.
And a lot of students ask, well, can I put these on like bull call spreads and take the credit in and just keep the credit for a year or two? And the answer is absolutely, and that's what we call our wealth builder strategy. So we're going to cover them both here in this session.
Yeah, let me just show a little here so you can kind of see where you place it will determine what you expect the stock to do. If you're going to put it above where the stock is, you expect the stock to go up. If you're going to put it, around where the stock is or below it, you want it to stay at least in this neighborhood or go up. That's the best thing. Remember, you're trying to be bullish here. That's the best thing, is to keep it around the higher strike, or at least above it.
I have students that ask me, well, so if I put this trade on and it is an 80-70 and the stock goes down, can I still make money? And the answer is yes.
Sure.
The stock could go down as far as 80.
Yep.
And you still make the maximum reward, whatever you pulled in for a credit. Now, it's not going to be as high.
Right.
And that's what you need to know, is that if you put on a bull put spread, depending on where you put your strikes at, the farther you go out of the money, the less you're going to take in. Of course, the higher the probability is going to be that you're going to be right too. If the deeper in the money, meaning the stock price is here, the farther up above you put that strike, those spreads, that means you're expecting the market to move in your direction. And you're going to take in a much bigger credit on this bull put spread, which is going to give you a higher risk reward over risk. But at the same time, you're looking for the stock to do something, and you're going to need the stock to actually get up and go above the strike price that you sold in order to take maximum profit.
Yep, exactly.
Okay. Let's talk about how to enter these trades. So let's get into some entry rules on bull put spreads. This is the wealth builder strategy we're going to cover first. We're going to cover the longer term strategy, then we're going to come back and we're actually going to look at an income type of strategy as well. But for bull put spreads, entry rules, first of all, for a wealth builder strategy, such as the one that George and I were talking about here, where we're going above the price, we're looking for options that are trading with 180 days or better. Basically, a good wealth builder strategy would use leaps. Okay, and there's several stocks out there you can look at right now that have this upward trend, that are getting higher highs and higher lows. The stock is scaling up. But we're looking for, once again, we're looking for long-term options. We're looking for an upward trend, higher highs, higher lows, and we're obviously looking to do this at a net credit. And now when you do a wealth builder strategy, expect to bring in a fairly deep credit, meaning that, let's say if you're going to do a 20-point spread, you're going to buy lower strike puts, sell higher strike puts, and this is going to be 20 points apart. You should be looking to take in 15, 16 points, a good bit of money, which is going to be the credit, the maximum profit. Your risk is going to be, and in that case, would be 20 minus 16, 20 being the difference between strikes, 16 being the credit. 20 minus 16 gives you your risk of 4. We'll expect to take in more, much more than normal because you're above the strikes. Okay, so that's what we use for entry rules.
Yeah, just make sure not to sell puts that are too deep in the money that have no time value.
That's right.
If you will be exercised.
If you got a trade, it's 20 points apart, and you can see putting this on for a credit of $19.90 to risk a dime, it looks too good to be true. It probably is, because what's going to happen is the market maker is going to come in there, and they like to look for little arbitrage trades, basically meaning that they can come in and exercise the put that you went short and cross it with a stock and take a quick reward on your behalf. So what you're looking for is you got to make sure that the stock that the stock that you're putting this bull call spread on in isn't too much, it isn't real deep below the strike prices, because if it is, you might be subject to an early assignment.
Sure, and what that means is if you sell a put, remember, when you buy a put, you have a right to sell the stock, but when you sell a put, you have an obligation to buy it from somebody at that price.
That's right. Okay, let's do an exercise. It's your turn to try this out. What we're going to do is we're going to look at buying the IBM 100-110 bull put spread. Okay, now this is for $7. And remember, I'm going to give you a little clue here. That $7 is a credit. It's not a debit. So when you look at this trade, you might think, wait a second, $7 risk? No, it's not $7 risk. So take a look at the trade again. We're going to go ahead and pause the tape for you. I want you to look for the maximum risk, the maximum reward, the break even on the trade. And we'll go ahead and pause the tape now, and we'll come back and review the answers.
All right, we're going to try to figure out these answers to the last test we had. Well, we did a bull put spread, which was the IBM 100-110 bull put. Remember, you're selling the 110 bull put. You're selling the 110 put and buying the 100 put, and therefore you're going to get a credit. Remember, the risk when you're doing one of these is going to be the difference of the strike prices minus your credit, which is 10 minus 7, which is $300. Your reward is your credit, which is $700 in this case. What you want to do is have the stock go over 110. Your break-even point, once again, is going to have to take, you're going to have to take your higher strike, which in this case is 110, subtract your 7, which is going to be the reward you took in, and you got a 103 break-even. Hope you got that one right.
Good. Okay. Calling this order in. It's not much different than calling in a bull call spread. The only difference is there's going to be one slight change. We're going to show you what that is and how to call this order in. So if the stock is IBM and the expiration month in this example is November, you've got strikes of 100 and 110, and we're going to take a credit in of 8.5 or 8.5. How do we call that order in? Okay. Well, again, first thing we want to do is, George and I know this by experience, is we want to go ahead and write the order up. Mm-hmm. So what we're going to do is we're going to write this order up, and it's going to look like this. Okay, the date, whatever the date may be, well, I'll just put 1-1, and the stock symbol, IBM. All right, what are we going to be buying? We're going to be buying IBM, November. Okay, that's your symbol, your expiration date, 100 puts. Okay, so we're buying the lower strike put, and we're going to sell the higher strike put, which is the 110 put. So we're going to buy IBM.
You're going to sell IBM.
Sell IBM, November, 110 puts. Now, this is a spread, just like the bull call spread. It's a spread. We don't care where IBM 100 puts are or where IBM 110 puts are. All we care about is we're doing this for a credit. We want to do the whole trade on one ticket, and the credit we were going to do this at is 8.5, so I'm going to write in 8.5 credit. And notice I put this on the sell side because that's where we get credits, okay? So again, this is a spread. I want to buy IBM November 100 puts and sell IBM November 110 puts for a credit of 8.5, opening both sides. So opening both sides just means that we haven't had this trade on yet. This is a trade we are opening up. All right? The other thing, too, that I want to mention is that if we are opening this as a credit, if we close it, we want to close it at a debit. All right?
Exactly.
Hopefully we can close it at a smaller debit than the credit we opened it at.
Exactly.
And that's the plan here, guys. All right. So wealth builder strategy, we're going to give you an example. And what we're looking at doing here is we're going to take a look at Microsoft. All right? This is an example, recent example, Microsoft trading at 65.50. And this is a bull put spread, so we're going to be using puts. We're looking at buying the lower, selling the higher, so we're going to sell the 100 puts, and the last trade on that was 35.50. That's what the 100 puts were going for. Okay, this is a long-term option. And we're also going to buy the Microsoft 80 puts, which we're trading for $19.90. So if we take the puts we sold, the 100 puts, and we sold those for $35.50. And then we actually subtract out what we paid for on the 80 puts, which was $19.90. Okay, this is going to give us the net credit on this position. Okay, the net credit on this position is $15.60, which is basically the difference between the two premiums.
Which you remember, this is for one share, but you're actually doing 100 shares. So you multiply that by 100, it's really $1,560 for each one that you do. Not just $15 to go buy a couple Happy Meals.
That's right. That's right.
This is quite a bit of money.
This is going to take Happy Meals and Tiffany's. But nevertheless, it is quite a bit less expensive than buying the stock. Okay, if we were to buy the stock, we'd be looking at paying $65.50 for the stock with unlimited risk.
Sure. Yep.
Now, the other thing I want to make sure note is that while George was talking about this, I'm moving the decimal place over to the right 2 times, and that's going to give me my real dollar cost. Second thing is that, well, what's the difference between strikes? let's take the 80 minus 100, give myself 20 points between strikes, and just by looking at these two numbers, I already know what my maximum risk is. I'm taking the difference between strikes minus the spread, the credit that I brought in, and that's going to give me a risk of $4.40, or move that over, $440.
Exactly.
Okay? Now, determining the break even on this position is just as simple. We can do it a couple of ways. We can take the 80 puts and add the 440 onto it to get 8440. Or we could take the 100 puts and subtract the $15.60 debit. And either way, we're going to come up with the same break even of 8440. And this is my break even to expiration. So where do I want Microsoft to be at expiration? At 8440 or above. Okay. So this is
let me draw something out here, just
Sure.
because since I'm, I think visually, this is the way I like to do things. I like to try to figure out, the stock right now was roughly at, 65.5. Okay, so this is where Microsoft is. I like to make sure that I can draw everything out, and I know that basically I've got, we did the 100s, okay, and we did the 80s, okay? These are all puts. You're going to sell these, buy those. So what this helps me do is visualize where everything's going to go. So in essence, what I want to happen here is this is a bullish trade. I'd love to have Microsoft close above here, and then I get the maximum reward. Okay. So once again, you got to realize where you place this bull put spread will determine how bullish or bear, or, how bullish you are in any of your trades. Correct?
That's right.
Okay.
A couple of neat things about these wealth builder strategies is that you might have a broker that allows that credit to be given interest to. So let's say we took this trade with 2.5 for 2 years to expiration, and you could get a 5% return on the credit. Well, now all of a sudden, instead of taking in the $15.60 that we talked about in this particular example, we can probably add about another $1.50 to that over the next 2 years. So all of a sudden now, my credit at expiration is somewhere in the neighborhood of $17 plus. So now my risk is not $4.40.
Sure.
My risk is now $3. And imagine if you could do that. What if you took in a 17-point trade that still had premium on it, so you wouldn't have to worry about the floor trader jumping in there and assigning you. Then we could take a $17 trade and maybe add $1.70 to it. To now we're taking in almost $19 of credit and 1 point of risk. That's where these trades make a lot of sense to me.
Yeah, and in essence, really what you're doing, the difference between owning, let's say, the stock is here, once again, going back to our other examples, is the stock has to go up to get the maximum reward, roughly 50%, okay, since where it is today. However, if it does go up this 50%, you're going to make, $15.60 on every $4.40. You're going to make over 300% plus. Almost 400% of your money.
That's right. A lot better than you do, I think, just buying the stock.
Sure, exactly.
And a lot less risk. Let's look at the risk graph on this position that George and I have just covered with you. Once again, we're looking at, remember, buying the lower strike put, selling the higher strike put. If you look at the risk graph in front of you, it's going to show, actually we've got 4 lines on this risk graph. This risk graph is taken right off of our website.
Yep.
And so you're going to see that the red line is today. So I'm just reiterating the fact that if Microsoft were to go up above 100 today, you're not going to take in your full amount of your position. This is a wealth builder strategy, meaning it is a long-term strategy. You're going to be in this trade not for a week, not for a month, but the better part of the time that you're actually in this trade to expiration. So this particular trade shows the limited risk of $440. That's on the downside. You've got the limited reward of $1,560. That doesn't include interest rates on this. We're just showing you the bare bones risk and reward on this trade. Also, you've got the break even, okay, which is $84.40 that you see there as well. And the black line that you're seeing, guys, this is representing the risk-reward line at expiration, which could be 2 years away.
Which is what we've been hand drawing here, but
That's right.
On the computer, it's a little more accurate.
Oh, it's much. Isn't it nice to just punch the numbers in and you just get the graph?
It's a big difference, yeah. And really, once again, those lines just tell you the effect of time decay, because options lose value over time, and that's what those different colors are.
Right. Okay, we've talked about entry rules. Let's talk about some exit rules, and this is for the income strategy. And the income strategy, once again, if you remember, George and I talked earlier. We talked about, remember, if it's, and I'm going to write this down here for you. If the bull put spread is in the money, okay, we're going to be using this is going to be using a longer time frame. Longer time frame. If the trade is out of the money, meaning this might be my stock price here. Out of the money would mean it'd be below the stock price. This is going to have a shorter time frame. And what do we mean by long and short? Well, long would be anything that's 180 days or greater.
Tom, you should have been a pharmacist with that handwriting.
I'm telling you. Okay, and short would mean anything, a short time frame, which would a lot of our traders, a lot of our students do, is they buy these 30 to 60-day options, and they basically are putting them just below the stock price, and that's what we call the income strategies. Right. They're going to take it in on a monthly basis.
Sure, exactly. And once again, we always said, and let me add this to his little list here, never sell naked puts, okay? And what that means, once again, and let me just give you a little graph here. Remember, once again, because you have the risk, problem, if you're going to have a put here that you sold, okay, make sure you either have a put that you bought above, a put or below, which is, these are all different strategies. A put to the side, right? You can do all sorts of strategies. The one we're discussing here is this one here, bull put spread. You'll definitely see all the others as we go. Okay, but remember, naked strategies are definitely can make you naked.
That's right. And when you guys come to one of our live events, you'll hear George say, not just never sell naked puts, never, ever, 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 ever sell naked puts, because we are really that passionate about this type of trading strategy. Exit strategies. Let's look at the exit rules for income strategy or the shorter term trades. What we're looking at doing is exiting half the position when you've doubled your risk. Now, let me explain that, because that's different than the bull call spread, but once you understand it, you'll realize it's actually the same. When I say double your risk, all right, let's take a look at an example. If we're going to take in, say, 1560, just like our last example, and we're going to have a risk, so this is my reward, and if my risk is 440, okay, well, what I'm doing is I'm taking double the risk. So I'm really looking at about $8.80 on this particular trade. And when my position drops to where I can buy the trade back for a profit of $8.80, I'm basically doubling my risk. I'm going to take half the trade off. Now I've got a credit spread which started up here at 1560 and has dropped in value, which is good. That's what I want it to do. As it drops in value, I can buy it back lower, buy it back lower. I'm going to do my first buyback when I've doubled my risk. Okay? The second exit strategy, just like the bull call spread, is when the spread reaches 80% of its maximum credit, you're going to take your profit, which basically means that the spread's going to do this. It's got to drop 80%. Of the total difference between strikes, meaning if I take this in at 1560, this Microsoft trade, well, the difference between strikes was 20 points. So 80% of 20 is going to be 16, which means in order for me to take 16 points in from 20, the spread actually has to drop to a value of 4. So my trade that I put on for $15.60, once I take half the value off when it doubles in risk, when that thing reaches a level of 4, that means I can buy back this spread for 4. Remember, folks, I just sold this thing a while back when I put it on for $15.60. I get to buy it back for $4. Okay, so I'm going to make an $11.60 profit just on the back half, meaning the half that I'm going to take off at 80% max or better.
Exactly.
Okay, so that's what we're looking at when we do the income strategy. All right. George, you want to add anything about bull puts?
Yeah, actually, I'd like to. The big question we probably get is, if the bull call spread and the bull put look the same on a risk graph, why would you do one over the other? And in fact, they do look the same. If we go back to the risk graph of both, they look the same.
They do.
Yeah, the big issue is, one is a credit spread, one's a debit. Some people like the credit spreads primarily because they don't have to exit the trade if they're right.
Right, and I think that on the other side, if we were to play devil's advocate on these two spreads a minute, I would think that as a novice trader, the debit spread is easier to understand because you're buying and then you're selling instead of the reverse.
I find people can understand the debit spreads better,
right.
At least when they're first starting. Yeah.
There's good and bad points about each one of them. The good point is that the debit spread is easier to understand because you're opening a credit, you're closing a debit. That means you're buying low and you're selling high. Okay, but if you're right on the credit spread, then you're going to save yourself about 50% in commissions if you want to hold the thing all the way into expiration, if you decide not to take the 80% rule that George and I talk about.
Sure. Well, we urge people to try both, at least paper trade and practice and try to see the one you feel most comfortable with, because that's what's going to make you successful.
That's right. One more thing, too, about the bull puts is the interest. You get the interest on your side when you take the credit in, okay? Instead of actually paying for something, you're getting interest on it. So that's also another little plus about bull put spreads.
Sure. And one of the things, if they, come to a live seminar, they'll see us doing it in front of them. We'll pick which ones to do right in front of them. Yep.
Absolutely. Okay, let's switch gears now and let's talk about the bearish side, how to take a credit spread in on a bear strategy, which is called a bear call spread. Okay, we only have one strategy on here. It's called an income strategy, and the reason why is because we don't take bearish trades for the long term.
Right.
It's just something that we just don't do. We find that the best way to make money in the market environments is to be a long-term bull and a short-term bear. So let's look at being a short-term bear using bear call spreads. We're looking for, obviously, number one, bearish market direction. Number two, we're going to use options that are 30 to 60 days to expiration. And the reason we kind of lean toward the 60 side is if you happen to put this on a trade that's, say, I call it a bow wow stock, like a stock that just doesn't move around a lot, but yet you still want to take a bearish position, you want to take a credit in, well, you may have to opt for the 60-day because there may not be enough premium in the 30-day options. So we're going to place this as a credit. We're going to sell the at-the-money to possibly out-of-the-money strike, and we're going to buy the out-of-the-money strike, the further out of the money. So we're looking at, obviously, in this case, remember with bear puts where we bought the higher and sold the lower? It's exactly the same thing with a bear call. We're going to buy the higher strike call, we're going to sell the lower strike call, and we're going to create a credit. Lower strike calls bring in more money than higher strike calls. So if you're going to sell the lower strike and buy the higher, you will take in a credit on the trade. Okay. Now we've got another great risk graph of selling naked calls.
You know how I feel about that.
I learned. Unfortunately, I laugh because I didn't get into the naked put trading real big like everybody else. But when I first moved to New York and started trading down on the American Stock Exchange, I was wandering around listening to what people were saying, and I heard the same two things out of a lot of people's mouths. And maybe they were just mouthing it to me just to get me into the trade so they could take the opposite side. But I heard that that options were meant to be sold. 90% of all options expire worthless. Just everything I could think of to get me sucked into the naked call trading. Right. And so I would sell calls, and then a month later I was buying them back higher. And I'd sell and I'd buy higher. And then finally I just realized, wait a minute, this is the wrong way. This is not working. Sure. And that's what our risk graph shows, is it shows a limited reward and an unlimited risk. And now, keep in mind, I was doing all this naked selling during, at the time, the biggest bull market in my life. So I really found out what the wrong way was all about.
Yeah, well, it's very dangerous, the naked call, because there really is unlimited risk.
Yes.
Where a naked put can go to zero, the stock can go to zero. This can go to whatever.
I think about these, and I think about stocks like Rambus and Yahoo and Qualcomm that, they're all down now, but the thing is when you're in them and you see these things escalating to the moon, it's just you gotta imagine, well, that could be a great diet plan if you're in one of those trades, because you won't be able to eat or sleep. Exactly. So what we're going to talk about is the right way of trading, which is the bear call spread. We're basically going to sell that naked position, but not be naked, because we're going to cover it by buying a higher strike.
Exactly.
Okay. The bear call spread risk graph looks much better. If you notice the broken line, which was the wrong way, now we've put in the red line for you, which is the right way. This shows you limited reward to the downside, okay, limited risk if the stock that you put the bear call spread on happens to go the wrong way. Okay, so this was called the right way. Now, let's talk about what happens with bear call spreads. And I like to call these things the buy the rumor, sell the news type of trades, because if you notice, a lot of times when an earnings report comes out, that stocks will start to escalate up toward the earnings report. And as soon as that earnings report comes out, they'll start to falter a little bit and then drop back down. That's what's called buying the rumor, selling the news. It also happens really well on takeover candidates that just aren't founded. And the first one I can think of is Honeywell, the Honeywell GE deal, where it fell apart. And that actually negatively affected both stocks. But they were buying the rumor, and as soon as the news came out that it wasn't going to happen, something came out and caused this stock to change trend. Okay, let's talk about the risk graphs for a bear call spread. Now, let's first start off with maximum reward, because that's what everybody wants to see, is the maximum reward happen in this trade. That's actually the net credit you take in on this particular position. The maximum risk is the difference between strikes minus the net credit you take in, and the break-even is going to be the lower strike price plus the net credit on the position. So that's basically the three things that we look at when we put together any risk graph, in this case the bear call spread.
Exactly. Well, let's look at a couple examples. It's probably a good thing to do, wouldn't you think?
Yep, we've got one here in front of the screen. What we're looking at is, for those of you watching the video, IBM. Oh, look. IBM's down $1. IBM's trading at 99. Now let's look at these particular bear call spreads. We have a 100 call and we have a 105 call. Now we're going to sell the 100 call and take in 5. We're going to buy the 105 call for 2. And that means, once again, guys, now think in bear call terms. So here's the call we're selling, and the call we're buying is up here. This is the protection. Okay, this is the area we don't want to go to, but if we do, we're happy because we at least had that protection on. All right, your maximum reward is going to be 5 minus 2. The 5 we took in, the 2 we paid out. It's going to be $300. Maximum risk, what's the difference between strikes? You look at the 2 strikes, we got 105 minus 100, so we got 5 points between the strikes. Minus the 3 we took in is going to give me my maximum risk is $200. And break-even's a real easy explanation. All we're looking at is the lower strike price plus the net credit. That's going to give me my break-even, which in this case, what's our lower strike price? 100. Our net credit was 3, so we're looking at 103 as our break-even. Do you want to show that visually, George?
Well, let me just show, once again, since I'm a visual guy, once again, we had IBM at $99 today. Okay, so we are going to sell the 100 call, okay, at 5, buy the 105 call. What do we have there? At 2. Okay, so that's really where you are. What you have is the stock below here. You've sold this. Hopefully what you want to do is take this premium in. You've got a credit here of 5 and a debit here of 2. So basically your credit equals $3. That's what you want. So remember, what you need to think about here is, remember what you've done by buying a call. You have a right to buy the stock at 105. But here, what's the opposite of a right to buy? You have an obligation to sell it at what price? At 100. Okay? Now, if you have an obligation to sell something at 100, when you finally do sell it, you will get $100. Someone has to give you 100 if that option is exercised. However, when you first started the trade, this would be a credit, the 100 that you get, when you also got a credit to begin with, okay, which is 103. That's how your break-even becomes the lower strike plus your credit, okay? And what you want to do is you want IBM to basically stay below, hopefully below 100. If it hits above there, then what you have is you have a $3 cushion, really what it's saying, until the point where you start to lose some money on that trade.
Yeah, let me add one more thing to this, is that this works really well, and I said this before, in stocks where we're escalating up on a rumor, and as soon as the news comes out, this is the expectation of the stock, is maybe it'll start to create lower highs and lower lows, and that's where we want it. Right here is where we want to put this thing on, right up at the top, and how do you know it's the top? Well, you don't know it's the top, but you know what you can find out is if there's news coming out at that time. There's so many times earnings reports make a good example of, of buying the rumor, selling the news. Takeovers, labor report days, things, global news as well as private sector news, meaning company reports. Those do really well. So now it's your turn. Okay, no, not your turn. Your turn. Okay, it's your turn to go ahead and do a bear call spread exercise. We've got an IBM 95-105 bear call spread, and that's going to be for a credit of $8. Look at the 95. What are we buying? What are we selling? Once again, we want you to plot the risk, reward, and break even. And we'll go ahead and pause the tape here. Once we come back, we'll go ahead and review the answers with you. So get to work. Okay, we're back, and let's take a look at the answers on the bear call spread exercise. Basically, what we have here is the risk graph, the answer to the risk graph of the IBM 95-105 bear call spread for an $8 credit. Let's look at our risk first. The risk is to the upside, in case this trade, which you think is bearish, decides to turn bullish. That risk would only be $200. The reward, which is the credit, that's your limited reward. Okay, that's the credit you took in on a trade, is maximum of $800. The break even on this trade, which again is going to either, you can do it one of a couple of ways. You can take the lower strike and add the credit to it, which will give you 103, or you could take the higher strike and you could subtract the risk from it. Either one's going to give you a break even of 103. Okay, so how do we call this order in? What we're going to do is we're actually going to go and write it up, make sure we write it up properly before we call it in. So we're looking at January options here. So let's just say it's just past Thanksgiving, George. We're stuffed full of turkey. Okay, we're looking at some stuffing with IBM. And what we're going to do is we think IBM is stuffed right now, and we think it's going to actually come down in price. So what we're looking at doing is actually putting on this bear call spread. So we're going to call it in this way. What we're looking at doing is buying the higher, selling the lower. We're going to buy the IBM January 105 calls, and we're going to sell IBM January 95 calls. Okay, we're buying the higher, selling the lower, taking a credit in, so my credit is going to be a credit of what? $800, the maximum, our maximum reward. 8 points or $800. I'm going to put it in as points, 8 points, which reminds me of something. If I put in $800 and I decide I want to do this 2 times or 10 times, do I want to keep the same points, or do I want to say, well, okay, I'm going to do it 5 times, so it should be 8 times 5. Should it be a multiple, or should we just keep it as a singular number?
Sure. Well, brokers usually, remember, when you're doing each spread, one spread's a spread. So what they'll do, brokers will typically say, what is your credit, and then they'll say how many times, 10 times, 5 times, 8 times, because that's really what you want. You don't call it in and say, I want a credit of a new car. You don't put a value on it. You put a per spread, I'm going to do this.
Yeah, and a lot of our students, when they first get started trading spreads, they think that's what they need to do, is actually think about it. Okay, well, I'm going to do this twice, so I need to put it in as a credit of 16.
Right.
If you put this in a credit of 16, you're never going to get it done.
Yeah, you don't get filled because the floor traders say, what's this guy trying to do? The value is
10-point credit for 16 points, that's right.
Yeah, exactly.
So realize that when you put these credits in, that you're going to do them on a singular basis no matter how many times you do it. And just like George said, is that you call it in, you give them the credit, and you're going to tell them how many times you want to do it. So if I were to actually just talk this through, I would say this is a spread. I want to buy IBM January 105 calls and sell IBM January 95 calls for a credit of 8 points opening both sides. That's the proper way to call this order in.
Sure, exactly.
Okay, let's look at another example. Let's look at a more recent example of something that we've looked at in a couple past seminars. And this is Eastman Kodak. Okay, Eastman Kodak is also looking a little bearish. It's got lower highs, lower lows. Stock's currently at about 43. We figure it's going to probably go down into the 20s. Okay, just by looking at the move here, it looks like the next move down is likely to be in the 20s. So what we're looking at doing is a bear call spread. We're looking at the options that we're looking for is basically 60 days or less. We're looking at with Eastman Kodak trading at 43. Basically, what we're putting up on the screen here is we want to sell the 35 calls, which are the higher price calls. We want to buy the 45 calls, which are going to be the higher strike or lower premium calls. And again, we've put something up here we haven't put up yet, which is the bid and the offers on each of these. And we know worst case scenario, we're going to wind up having to sell the bid and buy the offer because we're no longer on the floor anymore, so we can't take advantage of people like we used to.
Yeah, well, people have to realize that the floor traders, they pay a lot of money to be on the floor, and they're going to want something to do this trade, so they create this bid-ask spread, which is what you see on your screen right now.
That's right. And I joke around about floor traders a lot, but the fact of the matter is that they're there to create a two-sided market, and they're not going to do it for free. They're going to do it for a spread price. Okay. Exactly. Also, to keep in mind that when you look at spreads, the wider the spread, the more uncertainty it is for that stock price to be from one point to another, second to second during the day.
Sure. Exactly.
So we're taking a look at the spread again. What have we done? We've sold the 35 for $9.40. That's your bid. We're buying the 45 for $175. That's the offer on the 45 calls. Okay, what we're looking at is basically when you put this whole thing together, you're getting this trade done at a credit of $7.65. All right, that $7.65 is what you start out with, and we're hoping that Eastman Kodak will go down so that we can take that entire we can take most, if not all, that entire spread in.
Right.
And if you look at this risk graph that we're putting up on the screen for you right now, it's basically showing you what your risk is. Okay, risk is $235 or $235. Your reward's going to be what the risk graph looks like, which is again is at the top. The maximum amount you can take in $765, and we've got a break even of $42.65. Now, don't imagine that you're at the top of this thing about to slide down. Okay, this is not a water slide trade. What this is that you're actually sitting around the break even, and you want to actually go up this graph, which means that for you to go up in this graph, Eastman Kodak actually has to go down in price.
Correct. Yes.
Okay.
Yeah, it's a safer way than selling stock short. It's another way to be bearish of stock, but not sell it short, which some of our viewers might have done in the past.
Yep. So now that we've talked about entry rules and we've looked at a couple of examples, let's talk about how to get out of these trades. And to get out of them, basically, we again have two risk rules, or two exit rules, that have to do with risk. We're going to exit half the trade, just like the bull-put spread, when we double our risk value. And also, if the spread reaches 80% of its maximum credit, go ahead and take your profit. That means that if the trades, if I have a 10-point credit between where I bought and where I sold, if this thing drops down to where it's now at a value of 2, that's 80% of its maximum spread distance. So we're going to go ahead and take that off at that point. Okay. Let's do a recap on credit spreads, and then maybe do a little recap on vertical spreads as a whole, because we've talked about these in the last two tapes. First, I want to use these in mildly bullish or bearish markets. Okay, what that means is that we don't necessarily need the markets to go incredibly high or incredibly low. If we keep our strike prices close to the stock price, we're not looking for it to go too far. In fact, we could actually put it on and it could just go sideways and we can make money too.
Sure.
Number two, same risk curve as a debit spread. Okay, that's one thing that we need to point out, is that this looks exactly like a debit spread, and we talked about this earlier, how a lot of times you're looking at bull call or bull put, or bear call or bear put. It really, if you're just looking at it on a picture, you may be able to determine everything that you need to know about that trade except for whether it's calls or puts.
Exactly.
The risk and reward will help you determine whether it's calls or puts.
And sometimes based on the spreads that you're going to get from the floor, one might be a little better than the other. Sometimes they do that. Sometimes
That's right. That's right. That's called multiple exchange representation.
Yep.
And your broker should be able to tell you a little more information on what multiple exchange representation is. So number three. Well, obviously, we got to initiate this as a credit, or this is not a credit spread. Okay, so we got to make sure of that. Number four, your objective is to keep the credit you receive, or as much of it as possible. Right. Number five, the benefits of a naked option without being naked.
Sure.
That's the we have that as number five, but that's probably number one.
Exactly.
Is
right.
that this risk graph kills any possibility of you having unlimited risk.
Sure. Exactly right.
Okay, and now we've recapped this, let's take a look at maybe the difference between debits and credits once again, and then how we analyze them. So what I'm thinking about is We'll draw a line down the middle. We'll put debits on the left-hand side. We'll put credits on the right-hand side. And, you know, once again, differences between the two. Number one, easy. It's easy to understand. Okay? Number two, you're going to buy low. You're going to attempt to sell it high. That means the spread is low, not the market. Okay? The spread is low. You want to buy it low. You want to sell it high. All right? And that's why I think it's real easy to understand. Number three, okay? If you get assigned, assignment equals max profit. Because if you get assigned on this trade, you know, and assignment's a scary thing for people if they've never had it happen before. And if you get assigned on this trade, this is great because all you've got to do is go down and exercise the call that you are long or the put that you are long if it's a bear put spread. And what you've basically done is take care of the other side of the position. So they're going to set you up if you've got the IBM bull call spread and you're buying the 100 and selling the 120. If IBM goes up above 120 and you get assigned to 120, someone else on the other side of your trade has already given you the ability to sell IBM at 120. Now all you got to do is exercise your 100 call so you can buy it at 100.
That's your maximum reward. So you want to do that. You want to exercise, for example, a bull call spread, your lower strike call. Definitely lock it in.
We don't like praying for trades, but that's something actually that you're happy to take. That is the time to take assignment, is when it's on the short side of a debit spread.
Yeah, I think a lot of our students find debit spreads, like you said, easier to understand, at least to begin with.
Okay, credit spreads. We'll throw a few things out here. A credit is you have the money, and keep in mind, even though you have the money, it's not yours to spend, okay, until you actually physically take care of the other side of that transaction. Exactly. So that's number one. But you know what you also have when you have the money? You have the ability to take in interest. Right.
People can't go out and do whatever, $10,000 worth of credit spreads, take the money out, and then go to Macy's, can they?
That's right. I tried.
Okay. Well,
didn't work for me.
They don't like you to do that, yeah.
Okay. And then number two also is lower commission when you're right. Okay? And explain that to our students, George.
Sure. Basically, on a credit spread, if you're right, everything expires worthless, which means you don't have to get out of the trade, which is a good thing.
That's right.
Yep.
And now, really the thing we want to do here is when we look at these debit and credit spreads, we don't want to look at them and say, okay, I'm going to do the credit spread because it's going to give me interest or because I'm going to take lower commissions. What you do is you look at both of them, and you're going to determine which one has the better risk-reward because you could be looking at a matrix of options, calls on one side, puts on the other, and you could be looking at buy the 100, sell the 120 call, or buy the 100, sell the 120 put, and you could actually wind up with different risks and rewards on each.
Sure, exactly.
So it's important to analyze all the positions with the assumption that you expect that stock where you expect that stock to go.
Sure. Let me show them a little thing here. I like this kind of graphic myself. I think it helps maybe solidify what you're really doing here. Once again, if you buy calls, okay, let's say that's your position, and all of a sudden you can have calls above it that you sold, or if you sold calls below it. These are two different trades, but we just went through these over a two-tape period. Basically, this trade here is the bull call spread, okay, and this trade here is the bear call spread, okay. So people will know that basically, they're very different trades, but if you can kind of associate them where they are based on where the stock price is. On the put side, it's very much the same thing, okay? If you buy puts, you sell puts above, it's a certain trade. You sell puts below, it's a certain trade, okay? So what is this trade here? If you sell a higher strike put by a lower strike put, what are we talking about here? We're talking about a bull put spread, okay? And if you had a higher strike put and then had the lower strike put below it, you have the bear put spread, Okay. Remember, the bear call spread is this will be is that a debit or a credit trade? If you're going to sell lower strike calls, you're going to have a credit here, okay? And on the other side, if you sell the higher strike puts, you're going to have a credit there, and these would be your debit trades right here.
Okay.
I think I did that right.
Yeah, let me show the students one more thing. This is perfect. This looks great, George, because I'm going to change to red. Can we do this trade and this trade at the same time?
Sure, sure.
Interesting.
Absolutely.
So now what we've done is we've actually taken a bullish position and a bearish position on the same trade. So basically we can actually have it go two ways, or we can go sideways and expect it to stay in the middle.
Sure.
We could also do that with the puts. We could go bullish and bearish, which means we're actually non-directional, which is the start of delta neutral trading. And we're going to save this for another tape module.
Sure, exactly. It's a very creative, both of these are very creative strategies. You just got to learn how to be creative.
Okay, the other thing too is that, we can use this, and we said it before, but I'll reiterate it too, using the Platinum site.
Right.
Okay, we can use our Optionetics.com website to help create these positions. And the other thing too is that we could actually use it to evaluate a lot of the positions we have to determine which one is the best the best spread to do. Which best bull call spread, best bear call spread, bull put, bear put. And
once again, as you become more advanced, you can move them up or down, and you can get really, really creative with these things.
That's right. That's exactly what we do, too, folks, is that we will do a couple of things. We try to come up with the stock assumption. Next thing we try to do is come up with the best trade. And the best trade means that it may need some massaging by looking at the information that's found on our website at Optionetics.com. Last thing is let me close here with the debit and credit spread, saying that again we can do a lot of interesting stuff with them. We can actually create them to where they can go from directional to non-directional. They can be adjusted. So that kind of ends tape 3. What we're going to do in tape 4 is we're going to talk about ratio back spreads, and this is a way of taking a spread and actually making an unlimited profit potential versus what we've been doing so far, which is capped. The other thing too is George likes to call these vacation trades.
Yep.
A vacation trade means is that you can, when you put this on in the right market environment with the right amount of time to expiration, you literally can walk away from this trade. You do not have to look at it from day to day.
But one of my main objectives is to make more money and work less, and I think everybody wants to do that. And these are definitely one of those trades we'll go over.
Yeah, that's great. So come back and look at module number 4 when we discuss ratio back spreads.